Dividend investing is an amazing option for investors and allows you to build up a passive income stream. Welcome back to my channel, Physician Finances and Investing. I'm Joe, a resident physician. In today's video, we'll be talking about one of the strategies that I like to use in order to build up a massive dividend portfolio. So without further ado, you know what time it is. Let's talk about how to get that bread. What's up, YouTube? Welcome back to my channel, Physician Finances and Investing. So many people love to invest in dividend-paying companies, and for some people, these are the only type of companies that they will even consider investing in. Why? Because it's basically a guaranteed income. Now, a dividend is never 100% guaranteed. A company can decide to cut their dividend at any time as long as they get it approved by the board of directors. So you should never look at a dividend as though it's a 100% guarantee, but as long as you use the tips that we talked about in my previous video, you'll be on the right track to know if a dividend is a safe long-term investment and going to be able to provide you with that passive income. Let's quickly review some topics and then we'll talk about one strategy that I like to use in order to build up a dividend portfolio. A dividend is a distribution of a company's profits to its shareholders. Generally, a dividend is usually paid on a quarterly basis, meaning that it gets paid out to its shareholders every 3 months. But there are some companies that will pay a dividend on a monthly basis, and some that will even pay a dividend on an annual basis. There are even some companies that will pay out a quote-unquote special dividend, meaning that they pay out a large lump sum at a random point in time, usually around the end of the year, typically October, November, or December, and usually this has to do with tax purposes. So when evaluating different companies, what are some things that you want to look for? When trying to build a dividend portfolio, obviously one of the first things you need to know is whether or not the company actually pays a dividend. This information can be found on the Investors Relation page of any publicly traded company, and you can also find it on websites such as Yahoo Finance or CNBC. The next thing that you need to know is how long the company has been paying the dividend and how often they pay that dividend. When trying to build up a dividend portfolio, you want to find companies that have a long track record whenever it comes to paying their dividends. In general, at least 5 years, if not longer. If a company just started paying a dividend recently, then honestly, who knows what's going to happen? They may just decide to do away with it altogether. But generally, for companies that have been paying dividends for 10, 20, 30 years or longer, they're very committed to continuing to pay and to grow that dividend. And believe it or not, there are actually some companies that have been consistently paying and growing their dividends for over 50 years. We call those companies dividend kings. You also want to know how often the company pays their dividend. Like I mentioned, most companies pay their dividends on a quarterly basis. But there are some companies that will pay dividends monthly and some that will pay them on an annual basis. Knowing when a company pays a dividend is vital, especially if you're trying to build up a dividend portfolio that you're hoping to live off of in retirement. Nobody wants to get stuck living paycheck to paycheck, just waiting for that next dividend payment to come in. The next question that you have to ask is how big is the dividend yield and what is the dividend payout ratio? Now, I covered that information in my last video, so I'll refer you guys back to that video if you missed it and want to check it out. But in addition to that information, you also need to take a look at the company's balance sheet. Before deciding to invest in a company, you need to know what the financial health of that company is, and that's where the balance sheet comes in handy. For example, if a company has a ton of debt on their balance sheet, and then they get hit by a severe economic crisis, then guess what? That dividend is going to be the first thing that goes. Thankfully, all of this information can be found on any publicly traded company's investor relation page, and I highly encourage you to check out that information before deciding to make an initial investment in a company. The last thing that you need to ask yourself is what is the likelihood that the dividend is going to continue to go up year over year? Ideally, you want to be invested in a company whose dividend is going to continue to grow each year. So how do you go about figuring that out? This is where the income statement comes in handy, specifically taking a look at the revenue and the bottom line, the net income. Do you see that these numbers are going up year over year and quarter over quarter? For example, if you take a look at a company's income statement and see that their net income has fallen 3 years in a row, then that's a really bad sign for the health of a dividend-paying company. Generally speaking, you want to be invested in a company where you see that the net income is consistently growing every single year. If this is the case, then that's a great sign for the health of the dividend and the likelihood that the board of directors is going to continue to grow that dividend every year. So now that we've covered all of this foundational information, I'd like to move on and discuss a strategy that you can personally use to help build your dividend portfolio. Now for this example, I'm not going to be discussing specific companies, but rather just giving a general example. But in the future, if there's a particular company that you want to know more about, please feel free to comment below and I'll be sure to do a detailed analysis of that company. So when it comes to building a dividend portfolio, the key is consistency. If you're like me, then you're not going to have a ton of money available to you whenever you're first getting started investing. That initial 3% dividend yield that you're seeing on your $1,000 investment isn't going to go too far. But guess what? If you continue to be consistent, reinvest those dividends, and add additional principal to your account, you'll be amazed how quickly you can see your portfolio start to snowball. So for our example here, let's say that you have $1,000 that you're adding to your account each year to invest in dividend-paying companies. Without going into more detail about this specific example, for those of you who are just getting started with investing and aren't really sure how to go about evaluating specific companies, one stock that I would recommend checking out is SPHD. SPHD is an ETF that tracks the S&P 500 and pays out a monthly dividend. Do your own research, check it out, and comment below and let me know what you think about it. Now let's get back to the example. So with that initial $1,000, you decide to invest in a company that's paying a 3% dividend yield. So that comes out to be $30 a year in dividends. Now, I know what you're thinking, $30 is not a lot of money. But guys, this is where I challenge you to change your perspective. That $30 can be reinvested into other companies that also pay dividends. So for example, AT&T is trading at around $30 a share right now, and it pays a 5% dividend yield. So that's it for year one of investing. We're now moving on to year number 2, and you decide to add an additional $1,000 to your account, plus that $30 in dividends that you just received from stock number 1. And this time you find a company that's paying a 5% dividend yield and put that money into it. So now we're at the end of year number 2. You still have $1,000 invested into stock number 1 that pays a 3% dividend, so you get another $30 dividend from that company. But now this time you also have $1,030 invested into stock number 2, which is paying a 5% dividend, so you receive about $52 in dividends from that company. Your yearly dividend income has now grown to about $82 a year. So here we are in year number 3. You do some research and you come across stock number 3, which is paying a 4% dividend yield. You check out the fundamentals of the company and you like what you see, so you're ready to make that investment. You add another $1,000 to your account, plus the $82 in dividends that you received in year number 2. So with that investment, you have $1,082 invested in stock number 3, paying a 4% dividend yield, coming out to be about $43 a year. With the dividends that you're also receiving from stock number 1 and stock number 2, your yearly dividend income has now grown to about $125. You continue to do this every year into the future, and just imagine how quickly that dividend income can grow. And this can grow even faster too if you're doing it within a Roth IRA using the $6,000 that you're eligible to contribute to that account every year, and all of those dividends are tax-free. Guys, this is the beauty of dividend investing. If you're consistent, you can really see that dividend income start to skyrocket. And with the example here, we aren't even taking into account the fact that these companies, if they're fundamentally sound, are likely going to increase that dividend each year. And if that happens, guess what? The stock price is also probably going to appreciate. The key is being consistent and always doing your research. That's all the information that I wanted to cover in this video. I personally love dividend investing and have definitely made it a priority within my own personal portfolio. If you're just getting started with investing, make sure you grab your 3 free stocks from Robinhood and Webull to help you to grow your portfolio. I'll put a link to those brokerage firms in the description of today's video. As a reminder, I'm not a certified financial planner. I'm a resident physician who recognizes the importance of taking an active role whenever it comes to managing your finances, and I wanted to encourage others to do the same. So with that being said, I highly encourage everybody to do their own research before making any financial decisions. That concludes another episode of Physician, Finances, and Investing. I hope that you found this video both fun and informative. If you have any questions or would like me to talk about a particular topic in a future video, please feel free to comment below and I'll be sure to get that information to you. And if you haven't already, please smash that like button and click on the subscribe button to let me know that you like what we're doing here at Physician, Finances, and Investing, and to help support my channel. Thanks everyone, and have a great day.